Money on my mind, looking for a dime. James Lock in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Lock. Today we're going to answer two more Ask James questions of the day. And our first question is from Elaine. So she says, how do I know how much money to invest in stocks or bonds, and which specific investments will I need? All right, Elaine, well, let's dive deeper into that. And we talk about this a lot here on our channel. The first thing is, how much income do you need in retirement versus how much income do you want? So I define that as how much you need, as how much you need to live the same lifestyle that you had pre-retirement. But then we know that, when you retire, you have more time on your hands. More time, you want to do more things. That means you could probably spend more money. So now you have to figure out, okay, what are those things and how much extra do I need? But the difference gets added into, onto the need to create what I call the want income goals. Now here's where the math becomes really important. Let's say you determine that you need $60,000 a year to maintain your current lifestyle, but you'd like $80,000 to fund those extra activities and expenses and experiences in retirement. That's $20,000 difference. That's your discretionary income target. And this is where your asset allocation strategy becomes crucial. You want to be very methodical about how you structure this. So because bonds and bond-like instruments are often contractual, they pay a fixed income payment. Now, of course, there's still the ability for most of these things to go bankrupt or default, but if you're smart and you choose the right ones with high credit ratings, that's the lower probability of that happening. So what some people do is they actually satisfy their I need goals by Social Security, pensions, if you happen to have a pension, traditional pensions. Then they buy bonds and bond-like instruments. Now, when I say bond-like instruments, I'm talking about things like treasury bonds, high-grade corporate bonds, municipal bonds if you're in a higher tax bracket, and even some fixed annuities. The key is matching the duration of these instruments to your timeline. Now, if you need that income for the next 10 to 15 years, you want bonds that mature over that same period, creating what we call a bond ladder. Then they might, take the extra, the difference that I need and that I want, the difference between the I need and I want, and fund that with, say, dividends from regular stocks. Now, why is this a big deal? Well, because dividends for regular stocks can fluctuate. Now, over time, with healthy companies, they tend to go up. But in times of crisis, companies can cut dividends. That happened during the financial crisis in 2008. So, at least if your stocks cut dividends temporarily or permanently, at least that doesn't cut to the bone, right? At least you still have your I need goals covered. Now, what's particularly powerful about this approach is that it gives you both security and growth potential. The bond portion acts as your foundation. It's predictable and stable, but the dividend-paying stocks give you that inflation protection over time. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, they've been raising their dividends for decades, even through multiple recessions. That's the kind of dividend growth that can help maintain your purchasing power over a 20 or 30-year retirement. So that's something a lot of people do. Others are just really conservative. There's a huge pucker factor, right? If their accounts drop by even 10%, so they just stay in all bond and bond-like instruments. They don't care. They just want to take, they don't want to take that risk, right? Now, others have high risk tolerance. They know that most healthy companies do grow their dividends in the stock market over the long run. They want it all in high dividend stocks because they're willing to take that risk in retirement. But bottom line is they all go to that income first, growth second approach in retirement. So they're focused on income, satisfying their retirement needs and goals and wants from just the interest and dividends, and then any growth after that is icing on the cake. That's a great question. As always, if you have a question that you would like answered, email it. Email it to poollock@poollock.com. Our second question is from Joey. Joey says, I'm invested in bonds and I know that they're a contractual investment, but they can drop in value too. So wouldn't that affect my income? Joey, now that is a great question, and one that kind of is going to clear up a common misunderstanding about bonds and preferred stocks. We're going to dive deeper into this important topic because it's crucial for anyone investing for income in retirement. You're absolutely right. Bonds are contractual investments akin to a loan you make to a company or government entity. When you purchase a bond, you're guaranteed a fixed amount of income, typically paid as interest until the bond matures. Now, this fixed income is based on the bond's face value, not its market price fluctuation. So even if the market value of the bond fluctuates, your income remains stable and unchanged. In fact, if the market value of the bond drops, the yield or the percentage income relative to its face value actually increases, making it appear more attractive to new investors. However, your guaranteed dollar income remains unaffected by these market movements. Now, where the concern arises is if the bond's price drops significantly due to perceived or actual financial instability of the issuer. Now, this could signal an increased risk of default, where the issuer may struggle to pay back the principal amount at maturity or even fail to make interest payments. Now, in such extreme cases of default or bankruptcy, there is a risk of losing some or all of your investment. So this underscores the importance of diversification when investing in bonds. By spreading your investments across different issuers and types of bonds, you can mitigate the risk of any single issuer defaulting and impacting your income stream. Now, preferred stocks, on the other hand, share some characteristics with bonds, such as having a fixed income payout. They also have a par or face value and tend to kind of track more closely with the bond market than the common stocks. However, unlike bonds, preferred stocks don't have a maturity date and are considered perpetual investments. Now, this perpetual kind of nature introduces a slightly higher risk compared to bonds. But again, the fixed dollar amount of income is generally assured as long as the issuer remains solvent. Now, unlike common stocks, where dividends can be cut or suspended at the discretion of the company's management, bonds and preferred stocks offer a more predictable income stream. This stability is a key advantage for retirees relying on these investments for regular income. So in summary, while bonds and preferred stocks can fluctuate in market value, your income from these investments is generally insulated from these fluctuations, barring extreme circumstances like issuer default or bankruptcy. Now, diversification across issuers and types of fixed income securities is essential to mitigate these risks and ensure a steady income throughout retirement. Great questions today. If you would like to send in your questions, you can do so. You can email them to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.